Okay, welcome back. You got the market which is under pressure. Allcargo Logistics is the company that we're now talking to. Margins were impacted by one-off severance costs, and EBITDA slipped by some 31% on a year-on-year basis. But will there be better performance into the new year, FY25? We have Ravi, Jakhar, Chief Strategy Officer at Allcargo Logistics, joining us to take some questions. Great to have you with us here, Ravi. Prashant this side. Thanks for joining in. So it's been a tough year, right, overall for the business. Revenues for the full year are down 27%. EBITDA is down some, 60%. What should we expect in FY25? If you can give us an overall sort of headline picture in terms of a guidance, and then we can get into the individual segments for you.
Yeah, so I think, in our business, revenue is more of a derivative of ocean freight rates and therefore relatively less relevant. We had seen the first half of calendar year 2023, which was doing okay, and then the markets and the macroeconomic environment worsened. However, if you look at the last 2-3 quarters, the performance has flattened out, and the decline which was happening previously has already been arrested. This quarter 4, FY24, has also been flattish compared to FY24 quarter 3. Now, as we move forward, there are 3 businesses that we operate in. The international supply chain business is clearly seeing the rebound that we have been estimating, and we've been looking at second half of 2024 calendar year to be stronger in terms of demand, and we already see green shoots now. We noticed that on several trade lanes, we are already seeing ocean freights rise on account of increased demand, and that means that we should see improved container utilization, and that should mean increased volumes as well as improved margins in the second half of calendar year 2024. So that's something which is looking good on the international supply chain business. On the business side, we have always been very strong, both operationally as well as from a technology standpoint. And it was largely an outcome of macroeconomic environment, which was challenging over the last 3 to 4 quarters, but that's now clearly looking up. On the domestic side, the macroeconomic environment has remained buoyant, and the challenges are more internal as we were trying to turn around the express business. And I'm glad that we have achieved what we wanted to. If you look at the express business, the costs have been reduced by almost 7% on a cost per kg basis. And a large part of that is the last quarter of the year gone by. And if you look at the March exit rates with 7% lower costs, it has translated into improved gross profit, which is 15% higher, improved EBITDA, which is almost 115% higher sequentially. And as we look ahead, the international supply chain business would see sequentially improving performance quarter on quarter on account of revival in macroeconomic environment. And the express business would see sequential improvement on account of, all the cost reductions which have already been achieved. So from here on, we estimate that the quarters going forward should look better. Contract logistics business remains as stable as it has always been.
Can you put a number to it, Ravi? Is that possible overall?
So I would not put a number in terms of guidance, but like I said, every sequential quarter should be better from here on, and that's been our guidance for the last few quarters.
Supply chain and the express business.
Yes, for the international as well as the domestic business, both businesses.
Okay. Ravi, hi, good morning. Just a couple of more questions. In severance costs, you had said that severance costs will get concluded by August, right? Are we on track with that, and how much more is left?
Yes, we are absolutely on track with that. We have been reducing costs, and that, of course, is a impact on the severance as well. I would say this quarter has possibly seen maybe about $1.5 million overall in severance costs and other one-off cost impacts. Now, as we move into the next quarter, while there will be some severance costs with notices running into July, August, there would also be savings emanating from numbers already reduced in the quarter gone by. So I don't see major significant impact of severance costs in, say, the first quarter of FY25, maybe $500,000, they're not more than that. And second quarter should largely have no impact. And the cost reduction initiative should basically help us take care of all the escalations in staff costs on account of inflationary increases. And that means that despite all the headline inflation numbers being very high across global economies, we should be able to contain our SG&A cost. And that means that the entire gain in gross profits should go down to the bottom line. And that's the intent. And that's how we expect our margins to improve in the second half of the year.
So in terms of containing your SG&A costs, right, what's the total cost reduction? If you can give me that one number, how much are you going to reduce costs further by, and what is the impact it would have on your margins?
So various initiatives that we have taken across both in staff and general administrative expenses are in the range of about 25 to 30 million US dollars. And if you look at our total SG&A cost, which is north of 200 million US dollars, this means that any annual increments and all will be taken care of through these reductions. So that's the kind of impact. Basically, I'm talking about a 25 to 30 million dollar initiatives, which should allow us to completely offset all global increases, which would be otherwise standard in business. And that means that any expansion in business on account of volumes, improved utilization, all of that should come down to bottom line. And that's been the plan all through. And we should see the impact from July onwards on that count.
Ravi, so then, I mean, just give us a broad ballpark sort of idea. So margins were about 3.5% for the year gone by. What can this get up to as the business momentum picks up on both sides, all these cost reduction initiatives? What I mean, is there an upward bias, and where the ballpark?
So I would say that, in terms of the EBITDA margins, on a volume basis, could potentially see up to 50% increase from here. It is not appropriate to look at the percentage margins because revenue is, a derivative of ocean freight rates, like I mentioned. The primary driver in this business is how well your container is utilized. And today, to share an example,
so if you can,
trade lanes from
is it better to look at EBIT?
America.
Is it better to look at instead of the percentage number, EBIT per TEU? Is that a better metric? So
there are two parts of the business. One which is full container loads, which go in TEUs, and the second one which is LCL, which is in cubic meters. So overall, one is EBIT per TEU, and the second is EBIT per CBM. Of course, we get the combined number. I would expect that EBIT per TEU as well as EBIT per CBM should be ballpark growing in the same range, and therefore, as we expand the volumes and the profit margins improve, there should be an outcome of up to 40 to 50% kind of uptick should be possible from here.
Okay, all right. We will let you go on that note. Ravi, thanks a lot for joining in. Appreciate your time here. That's Allcargo Logistics.